the ultimate guide to profiting from the 2024 market crash, your investing opportunity of a lifetime. Imagine a scenario where a market crash isn't a setback, but a golden opportunity for wealth creation. That's the intriguing prospect we're exploring today. Welcome back to Ace Wealth Strategies, we're your trusted guide in the world of finance, wealth, and money. Your go-to channel for unlocking the secrets of building wealth. Today, we're delving into the potential 2024 market crash and how it can be a pivotal moment for savvy investors. Whether you're a seasoned investor or just starting, this video is your guide to not just surviving, but thriving in the face of a market downturn. Market crashes are not just about plummeting stock prices, they represent shifts in economic paradigms. By examining past crashes, like the 2008 financial crisis, we can identify patterns and triggers such as economic imbalances and investor panic. These downturns often stem from a mix of economic factors, from geopolitical tensions to policy changes. The impact is a rapid devaluation of assets, but also an emergence of unique investment opportunities. Understanding these dynamics is crucial. Now let's pivot to how we can prepare for the predicted 2024 crash, turning a potential crisis into an opportunity. Strategic preparation. As forecasts point towards a 2024 market downturn, the key to preparation lies in financial prudence. Building a cash reserve and diversifying your portfolio can provide a cushion against the crash. In preparing for a market crash, it's essential to build financial resilience. This means not only saving money, but also paying down debts, especially high-interest ones. A lower debt burden can provide more flexibility and less stress during market volatility. An emergency fund is your financial safety net. Aim to have at least 3 to 6 months' worth of living expenses saved. This fund helps you avoid liquidating investments at a loss during the crash and provides peace of mind, allowing you to focus on long-term investment strategies. Diversification and risk management. Diversification isn't just about spreading assets, it's about choosing the right mix. Consider including historically resilient assets like gold or government bonds, which often provide stability in turbulent times. In diversification, understanding the correlation between different asset classes is key. While stocks may plummet during a crash, other assets like bonds or certain commodities might hold their value or even increase. The goal is to have a mix that reduces your portfolio's overall volatility. Diversification isn't a set-and-forget strategy. Regularly review and rebalance your portfolio to maintain the desired asset allocation. This process involves selling some assets that have grown in proportion and buying more of those that have diminished. Investment strategies during the crash. As the market enters a downturn, it's time to execute well-planned investment strategies. This period, while challenging, can be ripe with opportunities for those who have prepared. Stay informed about market trends and potential recovery sectors. Use this period to research and identify companies that are undervalued but have strong potential for growth. Tools like financial news, market analysis, and company reports become invaluable. Investing during a crash requires emotional discipline. Avoid panic selling and be wary of herd mentality. Base your decisions on thorough research and long-term perspectives rather than short-term market fluctuations. Opportunistic buying. During the crash, asset prices fall, but their intrinsic value may not. This discrepancy is where informed investors can capitalize, buying undervalued assets poised for a rebound. Look for assets that are undervalued due to market overreaction. These could be solid companies with strong fundamentals that are temporarily undervalued. The key is to identify those with the potential for a strong rebound. Selective investment. Focus on companies with strong fundamentals, those with robust balance sheets and proven resilience in economic downturns. These are likely to recover and grow post-crash. In selective investment, thorough research is crucial. Analyze financial statements, understand the company's business model, and assess its competitive position in the industry. Look for companies with a track record of resilience and growth. While some high-risk investments might seem tempting during a crash, it's often wiser to avoid them. Stick to investments in companies with proven business models and avoid speculative bets on unproven technologies or industries. Acquiring assets at low prices is just the beginning. The real challenge and opportunity comes in managing these investments as the market begins to recover. As the market begins to show signs of recovery, it's time to think about strategic asset allocation. This involves adjusting your investment mix to align with the evolving market conditions and your long-term financial goals. Post-crash investment management. After the crash, the focus shifts to managing your investments through the recovery phase. This period is critical for solidifying the gains made during the crash and setting the stage for future growth. Stay active in managing your portfolio. This might involve selling some assets that have recovered well and reinvesting in others that have longer-term growth potential. Keep an eye on market trends and economic indicators. The post-crash market is a learning ground. Use this time to refine your investment strategies, learn from any mistakes, and adapt to new market realities. Continuous learning is key to becoming a more savvy investor. Monitoring and patience. Post-crash, the market will gradually stabilize and start recovering. This phase requires careful monitoring of market trends and patience, as some sectors will rebound faster than others. As the market recovers, some sectors may emerge as new growth areas. It's important to identify these and consider reallocating some of your investments to capitalize on this growth. This could involve investing in technology, renewable energy, or healthcare, depending on the market trends. It's crucial to maintain a level head during the recovery phase. Emotional decisions, like hastily selling off assets in fear of another downturn, can be detrimental. Rely on data-driven analysis and maintain a long-term perspective to navigate this phase effectively. Portfolio reassessment and adjustment. As the recovery unfolds, it's crucial to reassess your investments. Adjusting your portfolio to align with the changing market dynamics can maximize returns. In reassessing your portfolio, balance risk and reward carefully. While it's tempting to chase high returns in a recovering market, it's equally important to manage risk. Continue to diversify and consider the long-term viability of your investments. Long-term perspective. Remember, the goal is not just to profit from the crash, but to set up a foundation for long-term financial growth. Strategic decisions made during this time can have lasting impacts on your financial journey. It's important to set realistic expectations for post-crash growth. Recovery can be uneven and take time. Focus on steady growth rather than quick gains, and be prepared for potential market fluctuations. Finally, use the experience of navigating through a market crash as a learning opportunity. Stay committed to educating yourself about investment strategies, market trends, and financial planning. This continuous learning will empower you to make more informed decisions and build a robust portfolio that can withstand future market fluctuations. To sum up, profiting from the 2024 market crash involves a multi-phase strategy: understanding market dynamics, preparing beforehand, seizing opportunities during the downturn, and astutely managing investments post-crash. If our episode resonated with you, show some love with a thumbs up and share the wealth of knowledge. Let's journey together, turning challenges into stepping stones. Until next time, stay informed, stay inspired, and let's ace the financial game.